Okay, think about the last time you dropped 20 bucks.
Mm-hmm.
Seriously, without much thought. Maybe it was lunch, maybe a few coffees through the week, or, some little thing you picked up. Now, what if I told you that same $20,
Mm-hmm.
just redirected once a week,
Hmm.
could potentially grow into something generating over $6,000 a month? Passively, like 3 decades down the line.
It sounds pretty wild, doesn't it?
Yeah.
Almost too good to be true. But yeah, the sources we've dug into today, they actually lay out a specific path. It's a 30-year strategy. And the whole point of this deep dive is to really break down how that consistent, small, weekly what is that, like $1,040 a year? How that could snowball into a portfolio worth, well, over $750,000. And it's mostly powered by dividend compounding.
Okay, let's definitely unpack that. Maybe start with the basics, though. If for anyone listening who isn't, like, totally immersed in this stuff,
Yeah.
what exactly is a dividend? Why is it so key here?
Right. Good place to start. A dividend is, well, it's pretty simple, really. It's a cash reward. Companies take a chunk of their profits and pay it out to the people who own their stock, their shareholders. Usually happens every quarter. Think of it like a little thank you note, but, with cash. It's how they share the success.
That's the passive income angle right there, isn't it? You
Yeah,
get paid just for holding a stock. You don't have to sell anything.
exactly. Yeah, if you own, say, 100 shares and the company pays out $1 per share as a dividend, boom, you get $100 cash. Simple as that. But, and this is maybe the first big point from the sources, you kind of have to decide early on, do you want that cash in your pocket now, or are you aiming for much faster growth later?
Okay, so that's the trade-off. The yield you get today versus how much that dividend might grow over time, the DGR thing.
Precisely. That dividend growth rate, or DGR, stock paying 5% right now looks great for income today. But if that payout stays flat for 30 years, it's way less powerful than maybe a stock starting at 2% yield, but that grows its payout by, say, 15% every single year. For the kind of long-term goal we're talking about, that $6,000 a month, you really need reliability and growth. So the source of stress looking for quality, companies that have a solid history of paying and increasing those dividends, even when the economy, hits a rough patch.
Got it. Reliability, consistency. Makes sense. Okay, now let's talk about the engine. How does our little $20 a week actually turn into that huge number? $766,000. This is where it gets really interesting, right? The whole DRP versus non-DR thing.
Yeah, this is crucial. Let's use the example the source laid out. Imagine you invest $1,000 just once into something yielding a steady 5%.
Okay, $1,000, 5% yield. What if I choose non-DRP? So I take the cash dividends, maybe buy those coffees we mentioned. What happens after, say, 3 years?
All right, so non-DIP. You get $50 in cash each year. After 3 years, that's $150 in your pocket. Your original $1,000 investment, assuming the price didn't change just for simplicity, is still worth $1,000. So your total is $11,150. You got some cash, but your investment itself didn't grow from the dividends. There's no compounding happening on the investment.
Okay, $11,150. Now bring in the magic wand, DRIP, dividend reinvestment plans.
Right. With DRIP, that $50 dividend isn't cash in your hand. It automatically buys more shares of the same company, even tiny little fractions of shares. So let's run that same $1,000, 5% yield, 3-year scenario. Assume the stock costs $100 a share, just to make the math easy. Year one, your $50 dividend buys half a share. Now you own 10.5 shares instead of 10.
Okay. So year two, you're earning dividends not just on the original 10 shares, but on 10.5.
You got it. So your dividend in year two is slightly higher, $52.50. And you reinvest that too, buying a bit more stock. Keep that going, and by the end of year three, your $1,000 is now worth $11,157.60.
Wait, hang on. Let me get this straight. 3 years of effort. And the difference is between $1,150 and $11,157.60. That's $7.60, honestly. That feels tiny. Like, why bother? How does that tiny difference build a $766K portfolio? Sell me on this.
Yeah, I get it. It looks almost pointless at the start, doesn't it? That 760 is the seed. Compounding is sneaky. Its power is almost invisible early on. But that tiny difference, that $7.60, it's proof the engine is running. It accelerates, like exponentially over the long haul of the 30 years we need to hit that big target. Think of it like this. Your first $1,000 works for you once. But every single reinvested dividend, that's new money going to work immediately, buying more shares, which then earn more dividends, would buy more shares, and it feeds itself.
So that $7.60 difference, while looking kind of pathetic after 3 years, is the start of something that becomes hundreds of thousands of dollars later on, when we get to the 20, 30-year mark.
Exactly. That's the exponential curve kicking in. So that choice, reinvest or take the cash. It's basically essential if you want that massive long-term outcome. Okay, so if we know how to make it compound, now we need to know what to actually buy, right? You can't just randomly throw $20 a week at anything.
Absolutely not. So what were the main things the sources looked for, the criteria for picking these dividend stocks for the long haul?
Well, they broke it down into roughly 4 key areas. The first two kind of help balance that immediate income versus stability thing we talked about. First, sustainable yield. Yeah, a high percentage looks good now, but is it safe? Can the company actually afford to keep paying it, or will they cut it when things get tough? Which leads right into number 2. Company stability. You want businesses with a solid track record, consistent profits, almost boringly reliable.
You mentioned some industries earlier that fit that bill.
Yeah, the sources highlighted things like consumer staples, toothpaste, groceries, stuff people buy no matter what, and utilities. People need power, water. Their cash flow tends to be pretty dependable, even in a recession.
Okay, so quality, stability, resilience. Got it.
Mm.
What about risk? How do you manage that?
Good question. That's point number 3. Diversification. You don't want all your eggs in one basket, right? So spread the money across different sectors. The sources use examples like balancing maybe utilities with something like real estate or even tech. Don't just buy 5 banks, for example.
Makes sense. Spread the risk.
Yep.
And the last criterion, number 4. Sounds like it ties back to that DGR discussion.
Exactly. Growth potential. This is key. We're not just looking for a paycheck today. The stocks need to offer both that immediate dividend income and the potential for the share price itself to go up over time. That's capital appreciation. Plus, ideally, that dividend payout itself keeps growing substantially. That ensures your income 30 years from now is way bigger than today.
Excellent. Okay, criteria makes sense. Let's get concrete. Based on all that, the sources picked 5 specific stocks. These are the engine for that 6-day-a-month goal. Walk us through them. First up was CubeSmart. High yield, right?
Yeah, CubeSmart, ticker CUE. It's a REIT, real estate investment trust. They own and operate self-storage facilities. REITs legally have to pay out most of their taxable income as dividends, so they often have high yields. And storage is pretty stable. People always need space.
And the numbers look good for that blend of income and growth.
They do. Yield is high, almost 4.9%. And crucially, its dividend growth rate, that DGR, was strong, over 14% a year for the last decade. Plus, decent share price growth, too, so good income now.
Okay, high immediate yield covered. What's next? Something for diversification.
Exactly. Next is an ETF, an exchange-traded fund, specifically the Schwab U.S. Dividend Equity ETF, ticker SCHD. Think of an ETF like buying a whole basket of stocks in one go. SCHD holds lots of different high-quality U.S. dividend payers, consumer goods, healthcare, energy, etc. Instant diversification.
Okay, so the yield here is lower, like 3.5%. But the trade-off is safety, stability, less company-specific risk.
That's the idea. And it still has solid growth numbers, over 11% dividend growth rate, and decent share price appreciation, around 6.2%. It's the steady foundation.
Got it. All right, moving on. Kroger, that's groceries, right? Consumer staples.
Yep, Kroger, KR. Huge retail grocery chain, think Ralph's, Fred Meyer, those kinds of stores. Groceries are about as essential as it gets, so their business is very reliable, generates consistent cash flow.
Yield is pretty modest here, though, only 2%. So this isn't about income today.
Not primarily, no. This pick is really focused on that future income growth. Look at its dividend growth rate, almost 13.6% per year. That means the 2% yield you get today, relative to what you paid for the share, could be much, much higher down the road because the payout itself is growing so fast.
Okay, that makes sense. Investing for future raises. Now, the next couple sound like they're really focused on growth. Lowe's.
Yeah, Lowe's companies. LOW, the home improvement giant, benefits when people buy houses, fix them up.
Hold on. The yield here is even lower, like 1.87%. That seems really low for a dividend portfolio. Why this one when CubeSmart is nearly 5%? Feels like a weak link for income.
But this is where you really see that trade-off between current yield and future growth, the DGR. Lowe's yield is low because its dividend growth rate is just phenomenal, almost 18% per year over the last decade. That's huge. It tells you the company is aggressively increasing its payouts year after year. This pick is almost entirely about maximizing your dividend income in the future. Plus, it had great share price growth too, over 12%. You're sacrificing income today for potentially massive income later.
Okay, I see. So Lowe's is like buying future dividend paychecks that are growing incredibly fast.
That's a good way to put it. And finally, for a real kicker of growth potential and some international diversification, the sources included NetEase, ticker NTE. It's a major Chinese tech company, online gaming, e-commerce, Big, fast-growing markets.
Okay, got to push back a bit again here. We talked about stability, essential
Yeah.
services, a Chinese tech stock. That sounds like adding quite a bit more risk, doesn't it? Political risk, geographic risk.
Yeah. It definitely adds a different kind of risk, and that's a fair point. The sources likely included it for two reasons. One, getting exposure outside the US, especially to fast-growing consumer tech. And two, just look at the growth numbers. While it carries more risk, the potential reward is higher. It has a decent yield around 2.6%. But its dividend growth is over 17% annually, and its share price appreciation was stunning, almost 18% a year historically, according to the sources. So yeah, it's a measured risk aimed at maximizing both capital gains and future dividend growth.
Okay, so you combine the high-yield REIT, the stable ETF, the reliable grocer, the super-fast dividend grower, and a shot of high-growth tech. And that mix is designed for maximum long-term compounding.
That's the idea. And if you average out the stats for that whole five-stock portfolio, you get something like this. An average current yield of about 2.97%. Not super high today, but an average dividend growth rate of nearly 15%. That's the real power source. Plus, you're getting average share price growth around 9.5% on top of that.
Wow, okay, so that combination is potent. What does it actually mean for that initial $20 a week? Let's run through the timeline again, but with this portfolio.
Right. So year one, you put in $1,040. Feels small, like we said.
But keep doing that consistently. After 10 years.
After 10 years, thanks to the contributions, the dividends reinvesting, and the stock prices growing, the portfolio value hits about $19,697, starting to feel more real.
Okay, now let's jump another decade. 20 years in total. This is where you said the compounding really takes off.
Oh yeah, this is the inflection point.
Huh.
After 20 years of sticking with it, that portfolio value jumps dramatically to $188,242. For someone maybe starting in their 20s or 30s, hitting this point in their 40s or 50s, that's starting to look like real security.
And the final stretch. After the full 30 years, consistently adding that $20 a week, letting DRIP do its thing.
The total portfolio value reaches an incredible $766,842. And here's the payoff, the goal we started with. That portfolio is now generating $760,621 per year in dividends alone. Divide that by 12, and you get about $6,385 per month, passively. Goal achieved.
That's amazing.
Yeah.
$766,000 from $20 a week. But what's even more fascinating is where that value came from. You broke that down.
Yeah, the sources did. The total gain over the 30 years was about $675,642 on top of the money put in. Now get this. About $317,736 of that gain came from the stock prices going up capital appreciation. That's great. But a whopping $357,906 came just from reinvesting the dividends.
Wow. So the DRIP, the reinvestment, actually generated more wealth than the stock simply increasing in price.
In this specific model, yes, significantly more. The act of reinvesting the cash generated by the stocks was ultimately more powerful than the underlying price movement itself.
So the big takeaway really seems to be it comes down to three things.
I think so. One, consistency. You got to stick with that $20 a week, week after week, year after year. Two, DRIP is non-negotiable for this kind of outcome. You have to reinvest those dividends automatically. And three, selection matters. You need stocks chosen specifically for that combination of stability and, crucially, high dividend growth.
Right. Which brings us to maybe a final thought for everyone listening. Something to chew on. If, in this model, reinvesting the dividends created over $357,000 of the wealth, while the stock price growth created only $317,000, how much weight should you really give to that starting yield, like CubeSmart's nearly 5%, versus the dividend growth rate, like Lowe's almost 18% increase per year? That choice between focusing on income now versus focusing on income growth later seems like it's the absolute core decision that drives where you end up decades from now.
It really is the central question, isn't it? Something to definitely think about next time you've got that $20 ready to go.